Welcome to Business Basics Hub. So you filed the paperwork, you've got the shiny new logo, and you are totally ready to conquer the world. But hang on a second. Starting an LLC so you can be your own boss is a fantastic feeling. You're finally in charge, right? Well, maybe not entirely. Without one specific document, you might actually be surprised to learn that the state is writing the rules for your business. But don't worry. Today on this explainer, we're going to fix that and put the power right back in your hands.
Before we jump right in, just a quick bit of housekeeping to set the stage. This explainer is for general educational purposes only and is not legal, tax, or financial advice. We're simply here to give you a really clear, beginner-friendly foundation today.
Here's the roadmap for today's explainer. Number 1, what is an operating agreement? Number 2, why it matters. Number 3, how to create one. And number 4, beginner mistakes to avoid.
Okay, let's dive into this. Section 1. What is an operating agreement? The rulebook for your LLC.
In plain English, an operating agreement is basically a legally binding contract between the owners, who, by the way, are called members, of a limited liability company. Think of it like the ultimate constitution for your business. At its core, it's a comprehensive how-to guide that replaces generic state laws with your very own custom rules. It covers the whole shebang, from how your LLC is managed, to how money flows in and out, to how major decisions actually get made. But let's think about what happens in the void if you don't have this constitution. Without it, you are automatically enrolled in a generic, one-size-fits-all set of state laws. And let's be honest, those default laws probably don't care at all about your specific business goals, your unique financial situation, or your vision for the future. Once you and your co-owners actually draft and sign an operating agreement, those custom rules become the exact rules you play by. It takes all the guesswork out of running your company, and it ensures you are the one in the driver's seat, not the state.
Section 2. Why it matters. Protecting your business and your personal assets.
Now, what's really interesting about this slide is that even if you are a completely solo business owner, you absolutely need this to protect your personal savings and your home. First and foremost, this document protects your personal assets. If you don't treat your business like a separate entity by having this formal agreement in place, courts might just treat your business like a simple sole proprietorship. If that happens, the liability shield of your LLC completely crumbles. That puts your personal home, your car, and your family's savings entirely at risk. Second, it overwrites those generic state default rules we just talked about. Let's paint a picture here. Imagine you're doing 90% of the daily grueling work for your startup. But because you didn't draft this agreement, your state's default rules legally mandate that profits are split 50-50 with your silent partner. Ouch, right? An operating agreement prevents that exact nightmare by letting you define fair compensation from day one. It also prevents member disputes by putting everyone's expectations right there in writing. Next, it's highly practical. Banks and lenders almost always require a copy of it before they'll even let you open a business checking account or apply for a loan. And again, just to reinforce this vital takeaway, even for single-member LLCs running a totally solo operation, it is essential. It proves to the world, to the bank, and to the courts that your business is a legitimate, separate legal entity and not just a hobby.
Section 3. How to create one. A simple step-by-step guide. Don't worry, creating this document is highly actionable and totally manageable. We can break this preparation phase down into 4 simple steps. Step 1. Check your specific state's rules. While most states don't legally require this document to be filed with the government, 5 states actually do mandate having one on record. So it's definitely best to know your local laws right out of the gate. Step 2. Gather your basic LLC info. You'll need member names, addresses, and the initial capital contributions. That basically means a clear written record of exactly who put in how much money or property to get the business off the ground. Now we move into step 3, and this is where the real power lies. Decide on your key rules. This is where you figure out who actually pulls the levers in the business. Will all members manage the daily operations equally, or will you appoint specific managers to run the show? You'll also decide exactly how profits and losses are split, down to the percentage point. Once you've made those tough decisions, transition to step 4, draft the agreement. Take all those decisions and put them into clear, easy-to-understand language.
All right, once that initial draft is done, here's how we bring it across the finish line in the finalization phase. Step 5. Review it carefully with all the members. Everyone needs to sit down and understand exactly what they're agreeing to before moving forward. There should be 0 surprises here. Step 6. Sign the document. Every single member must sign it to make it a legally binding contract. Step 7. Store it safely. Unlike your articles of organization, which is a matter of public record, this is a private internal document. you do not file it with the state. In fact, the Small Business Administration recommends keeping it strictly confidential in your own company records. And finally, Step 8. Update it periodically. Listen, your business isn't static, and this document shouldn't be either. As your business evolves and changes its management structure, like, say, bringing on a new angel investor, adding a new partner, or shifting operational roles, this document absolutely must be formally updated to reflect your current reality.
Section 4. Common beginner mistakes. Pitfalls to avoid.
So, the crucial point is avoiding the absolute most expensive and stressful errors new owners make. The biggest mistake? Operating without one at all. If you skip this, as we learned earlier, the state is literally making your rules for you. Second, using unedited, generic templates. Downloading a free one-page form from the internet and just filling in the blanks without really understanding it can leave you with rules that simply don't fit your business. Or worse, they might completely violate your specific state's laws. Third is relying purely on verbal agreements or a friendly handshake. Guys, this is a massive risk. Relying purely on a handshake is a recipe for disaster. When the business is brand new and making $0, everyone's best friends. But fast forward 3 years when there's $100,000 in the bank on the line, memories fade quickly, disagreements flare up, and friendships break. Written contracts do not forget. Fourth, forgetting to update it. An outdated agreement from 5 years ago for a business that looks completely different today is a huge legal liability. And finally, missing buyout rules. Many partnerships fail, not because the underlying business fails, but because partners cannot agree on what happens when someone wants out, gets divorced, or unfortunately passes away. You absolutely must set your exit and buyout rules right at the beginning, long before you ever actually need to use them.
So, are you ready to take control of your LLC and write your own rules? If this explainer helped you gain some business clarity today, please give it a like, subscribe to the channel, and turn on notifications so you never miss out on more Business Basics Hub content. And hey, feel free to share this with a friend who's starting a business too.
To wrap things up today, I'll quickly read through our standard outro disclaimer. This content is for general educational purposes only and is not legal, tax, or financial advice. Laws and requirements vary by state and individual situation, so consider consulting a qualified professional for guidance specific to your business. Before you close this explainer, I want you to ask yourself a quick question. If a dispute happened tomorrow, who is really in charge of your business, you or the state? Thanks so much for learning with us today on Business Basics Hub, and we'll see you on the next one.